Hello YouTube, the John Vanderveer here. Today we're going to do an economics video. This will be foreign exchange. We're going to be talking about the euro and the dollar. And today is December 1st. It's about 6:20 p.m. And yesterday morning, the Band of Six, or it's called something like that, 6 central banks from around the world made a group effort to extend a lot of credit to various people, primarily Europe, for various reasons, primarily to help the European financial crisis. And one major actor was the United States, which made available funds to Europe for a super discounted rate. And this has both fundamental and nominal implications for the exchange rate, so that's why we're talking about this. And what happened right after that was that the euro went up in value and the dollar went down in value relative to each other, which you may expect intuitionally. And this is because the United States is a more economically efficient country than the Eurozone on average. And so you would expect that by us sending them economic assistance, their economy would improve, ours would be worse off. And so you would expect that. And you would also expect that they would sort of equalize. Well, here is the problem, is that the euro is worth more than the dollar, and it was before and still is. And so it was trading at about 1.33 dollars for 1 euro. Yeah. And now it's trading at about 1.345. So it went up. Well, so there's a couple ways we might explain this. What we would say, what we would expect is that yes, the euro would improve and yes, the dollar would get worse, but they would move towards a 1-to-1 ratio. Well, since the euro was already worth more, it in fact deviated from going to the 1-to-1 ratio, and it went further away. What we would expect is it would go closer to a 1-to-1 ratio, because if we take all the euros away and we just give them a bunch of dollars, that would be 1-to-1, right? A dollar would be worth a dollar. So why isn't the American dollars watering down the euro? Well, there's a couple ways to explain this. First of all, if we're trying to explain it with fundamentals, then we would say, well, maybe it's not moving towards a 1-to-1 ratio because the purchasing power parity is not 1-to-1. Purchasing power parity, if I can get an orange in Mexico for 5 pesos and an orange in the United States for $1, this is really crazy, I'm just making this up, then your purchasing power parity would imply that your real exchange rate is 5 pesos to $1. So maybe it wasn't moving towards 1 peso to $1 because it was moving towards 5 pesos to $1. You see what I'm saying? In other words, maybe it was a move back towards the true purchasing power parity. Okay, well, this kind of makes sense, except that it's really bogus, because I actually looked up the legit stats from OECD.org, and the exchange rate, it shouldn't be doing that. It should be moving, the euro should be moving down. And also, the only other fundamental way we can explain this is maybe they were moving towards a future projection. Like maybe they're saying, well, in the long run, Europe will outperform the US. And that would cause them, even though right now the currency isn't valued correctly, they could be speculating. And that would also explain it. Well, this is also bogus. And same source, OECD.org. This place is the Economic Outlook. The Organization for Economic Cooperation and Development, OECD. So if you look at the per capita GDP, which is an indication of productivity, and if you just look at their measurement for industrial production, labor productivity, for example, the United States is not at the top, which surprised me. Actually, Korea is even better than us, and like some places I really didn't expect, which pissed me off. But we do beat the entire euro area. The United States is significantly higher than the entire euro area on average, and it's projected to continue that way. So you would expect that in the long run, the dollar would appreciate and the euro would depreciate. And also, if you look at per capita GDP in real value, not nominal value, real value, and so you make it all certain currency and you correct for the year, you make it a certain year and take out inflation and all that. The United States is like number 3 on the list. It's like Sweden, something Sweden, United States, and it's projected to keep being number 3. And the Eurozone on average is like way down the list. So this explanation is really terrible also. So in other words, fundamentals had nothing to do with this shift. What should have happened fundamentally was the euro should have actually gone down in value and the dollar should have gone up in value, because they should have equalized, because the euro was originally worth more than the dollar and we injected dollars into the eurozone. So the real reason the euro went up was not a fundamental reason, it was a expectations reason. Now there's 2 things that shape the market. There's fundamentals and expectations. And expectations is just that. If you want something to happen, economically, there's actually a variable in equations which represents you wanting that to happen, because people play a role in economics, right? And so in a weird way, if you, not so much if you, but if a market, if everybody wants the dollar to go up, it'll just go up, because they'll all say the dollar's worth more. Even if it's really not, they'll think it's worth more, they'll increase demand for it, and economics takes it away from there. Once demand goes up, it has certain effects. So there was an expectations increase, and this expectations obviously came from the fact that they said, oh look, the United States gave Europe money, now there's hope that Europe won't break apart and all this. So it was really a psychological expectations thing, and they're hoping that in the long run, the Keynesian effect, the multiplier effect, all that bunch of garbage will help recover the European Union. Well, there's a few things going on here. First of all, there's the thing called overshooting. Overshooting and expectations, especially with foreign exchange, says that when something happens due to a fundamental shift, and the expectations will overcorrect for it. So if productivity in the United States increases, then in the short run, expectations will increase the value of the dollar more than the fundamental shift of the increase justifies. So they'll overcorrect. So say the economy gets a little bit better, people will go, yay, and they'll overshoot more than they should have. And then they'll later on correct back downwards. They'll correct back downwards to the new higher point. But if the fundamentals go down and you're overshooting up, that shows there's going to be a huge correction, because you're not going to get a little reality check where you go from here up to here and back down to here. You see what I'm saying? Your fundamentals are going here, but you're going here. So you're going to get it's going to be a double strong correction. So that's the thing to consider with overshooting. Now, here's the other thing, and that overshooting is a relatively short-term effect. I think you'll start seeing the overshooting correction in the next, at longest, the next 2 months, probably closer to the next week or 2. You'll see the euro versus the dollar go down. The euro versus the dollar go down. And euro versus the dollar means the number of American dollars which can be bought with a euro. 1 euro, how many American dollars that's worth. So right now, it's at like 1.346. And I'm telling you, that's going to go down. This is my prediction. And that's based both on the fundamental thing that we're watering down the value of the euro, and on the idea that overshooting, and here's the third reason, is that Keynesian economics is garbage, and the multiplier effect actually isn't going to help them, it's actually going to hurt them. Now, this will eventually be countered because the Fed has been doing quantitative easing here too. So that effect is going to get watered down and not be as severe, because yes, they're quantitative easing in Europe, but they're also quantitative easing in the United States. So really what it comes down to is how much quantitative easing, which right now we don't know how much they're going to do in Europe, and we don't know how much the Fed's going to do in QE3, or precisely when QE3 is going to happen. So I'm not going to guess based on that, but I am going to guess based on the fact that QE3 will be after after January, which I could be wrong, but I'm going to be assuming that's going to be after January. So between now and January, I should expect that the euro versus the dollar will go down, and that's the prediction I'm making. And right now, the euro versus the dollar is trading at 1.346, and I'm going to predict that it's going to go back down, and I'm going to be conservative and say it's just going to go back down to where it was before they got injected, and I'm going to say it's going to go down to 1.3315 dollars can be bought with a single euro. So that's the prediction I'm making. I'll be short selling the euro, and I'll give y'all my findings in I guess a couple weeks, and I hope that you've learned something about foreign exchange in this video. Have a good life.